Welcome to the Torch Academy. In this episode, we're covering what to do with the money. The biggest financial decision of your life comes right after the high of selling. Americans spend roughly $847 billion a year on financial advisory services. And here's the uncomfortable truth. Most of that advice is designed to sell products, not build wealth. The financial advisory industry is full of good people, but the way many of them get paid creates real conflicts with what's actually best for you. As a seller about to deploy a large sum of money, the single most important decision you make in the next 6 months isn't what to invest in. It's who you trust to help you decide. Rule number 1, do nothing major for 6 months. You just experienced the biggest emotional and financial high of your life. Your brain is flooded with dopamine and relief. This is exactly when people make terrible decisions. Buying a vacation home, paying off every piece of debt they have, starting a new business, writing checks to relatives. None of those moves are inherently bad, but none of them are good decisions right now either. Let yourself settle. Let the dust clear. Then, from a calm place, decide what actually matters to you. The advisor landscape looks confusing from the outside, but it comes down to 4 things. First, look for fee-only advisors. They're paid by you, hourly, or as a percentage of assets, so their incentives actually line up with yours. Second, make sure they're held to a fiduciary standard, which legally requires them to put your interests first. A commission-based advisor isn't. Third, find someone who specializes in business sellers, not just general retirement planning. The tax and cash flow picture post-exit is very different from the typical client. And fourth, ask directly about conflicts. If they earn commissions on products they recommend, you want to know how much and on which products. Trust your skepticism here. It's healthy. There are 3 red flags worth watching for. First, proprietary products you've never heard of. If an advisor is steering you toward an investment that's only available through their firm, that's a sales pitch, not a recommendation. Second, fees above about 1% of assets under management without a clear reason. Fees compound year after year, and the math starts to matter at any portfolio size. And third, pressure to move fast. A real fiduciary is comfortable with you taking your time, getting a second opinion, asking hard questions. Anyone pushing you to decide quickly is selling, not advising. Most advisors charge a percentage of the assets they manage for you, typically 0.5 to 1.5%. On a $1 million portfolio, a 1% fee is $10,000 a year. Scale that up or down to whatever your portfolio actually is. That can still be competitive for the right advisor, but you need to understand what you're paying and what you're getting for it. Fee-only advisors often work differently. Hourly rates in the $250 to $500 range or flat project fees. Neither model is automatically better. What matters is that the fee is transparent, proportional to the work, and that the advisor isn't also earning hidden commissions on top of it. Once you know you want to invest, there's a real question. Put it all in at once or spread it out. Dollar cost averaging means investing a fixed amount each month over 12 to 24 months. It reduces timing risk. It's psychologically easier because no single day feels like one huge bet, and it's a good fit if you're unsure about market conditions. Lump sum means putting the money to work immediately. Historically, markets go up over time, so lump sum tends to perform slightly better on average. Both approaches work. The honest truth is that the biggest advantage of dollar cost averaging isn't returns. It's emotional comfort. Pick the one you can actually stick with when markets get rough. Over 20 years, tax efficiency can quietly add back 20 or 30% to your returns, so these strategies matter. Municipal bonds pay interest that's often tax-free at the federal level and sometimes at the state level too, especially valuable when you're in a high bracket. Roth conversions are powerful in the low-income years right after a sale. You pay tax now at a lower rate, then everything grows tax-free forever. Tax loss harvesting means intentionally realizing losses to offset gains elsewhere in the portfolio. And for highly appreciated assets, sometimes the smartest move is to hold, because the step up in basis at inheritance can erase the gain entirely. These aren't loopholes, they're just how the tax code rewards thoughtful long-term planning. Here's what a Roth conversion can look like in practice. Mike sold his business for $8 million and paid $2 million in taxes, netting $6 million. In his first year after the sale, he had essentially no business income, no W-2, no earnings from operations. His advisor spotted the opportunity and converted $1 million of his existing 401k into a Roth IRA that year. He paid about $370,000 in conversion tax, painful in the short term. But that million now grows tax-free for the rest of his life. Over 25 years, that's potentially $4 to $5 million of tax-free growth he wouldn't have had otherwise. Low-income years after a sale are one of the most underused wealth-building windows you'll ever get. These are the mistakes sellers make over and over again, lending to friends or relatives. You're not a bank, and this almost always ends in damaged relationships and unpaid debt. Starting a new business immediately, the itch to do it again will hit you, but your judgment in those first months is compromised. Wait at least a year. Lifestyle inflation, a nicer house, better cars, more travel, all reasonable in moderation, but many sellers burn through shocking amounts of money before they realize what's happening. And investment tips from friends and family: your buddies are not qualified advisors, no matter how confident they sound. The pressure you're feeling from people around you is real, and you have full permission to say no. This one is hard, but it's important. Once word gets out that you sold, friends and family will ask you for money. Say no. Lending to the people closest to you almost always destroys the relationship and usually ends in unpaid debt. If someone is asking you for a loan, they're telling you they don't have other options. And if they had good options, they wouldn't be asking you. So there really are only two honest choices. Either you want to give them the money, in which case give it, don't call it a loan and pretend it'll come back. Or you don't, and saying no now protects both your wealth and the relationship. There's no middle path that ends well. Here's a framework you can actually use. Month 1, rest. Park the money somewhere safe like treasuries or a high-yield account and don't touch it. Months 2 and 3, interview 2 or 3 fee-only fiduciary advisors. Take your time, compare approaches, make sure the one you pick understands business sellers specifically. Months 4 through 6, work with that advisor to design your investment strategy, factoring in your time horizon, your tax picture, and how much risk actually helps you sleep. And from month 6 onward, start deploying the capital, lump sum or dollar cost averaged, and meet with your advisor quarterly to adjust. You don't need to have it all figured out in week 1. You just need a plan. And this is the plan. The biggest takeaway: the emotional high of closing a sale is the worst time to make life-changing financial decisions. Park the proceeds somewhere safe, take 6 months to decompress, and work with a fiduciary financial advisor to build a long-term plan. The sellers who protect their wealth are the ones who resist the urge to act immediately. Thanks for watching. If this episode was useful, head over to torchapp.io/signup and create your free account. Torch uses AI to help you navigate buying or selling a small business. Whether you're just starting to think about it or ready to take action, we can help. And don't forget to subscribe for more episodes from the Torch Academy.